to single stock options program with our fifth workshop titled A Deep Dive into Options Pricing. Allow me to introduce myself. My name is Hind Asaf, representing Tadawul Group. We have our colleague Mark Taylor. Mark is very professional in options and options trading. This workshop is counted as our fifth workshop on single stock options program. We still have one more workshop to go. Please feel free to reach out or to even review our previous workshops on YouTube. It's all been recorded under Tadawul Group channel on YouTube. So with that, I would leave it to Mark to start.
Good evening, everyone. Welcome back. As we've just heard, this is session 5 of 6 in this webinar series on single stock options. If you've missed any of them before, please go back to the YouTube channel and find the ones you've missed. As we've just heard, they've all been recorded. Session 5 is probably the most complex of all of the 6 sessions because we're going to talk in a bit more detail about pricing. In session 3, at the end of the first half, we did talk about pricing, but we talked about it in a very gentle and intuitive way with no mathematics at all. And then that's essentially set us up nicely now for understanding how we might dig a little bit deeper into pricing and try to work out those price drivers that we discovered in session 3. How do they actually have a mathematical effect on the price, and what is the justification for including all of them in some kind of formula that we might use to price options. So we're going to go through the theory of pricing options today. It should take the usual hour or so, which will leave us with probably at least 15 to 20 minutes at the end for any questions that anybody might have. There is an email address at the end of all of these sessions. So just to reiterate, if you do have any questions, then please feel free to email those through. And I'll show you that email address again at the end of today's session. Any interesting questions that come through to that email address, we will use those as the basis for what we're going to talk about next week. Next week is more of a free-form session where we've got a significant amount of time available for questions and answers, which could be questions either received on the day, or it could be questions that we've received in advance on the email address. So if you've got anything you'd really like discussing in session 6 next week, please feel free to email that through. As usual, if you're in the Zoom room right now, you can drop any questions you've got onto the chat, and I'll try and answer those in as close to real time as possible. And I will be asking you questions as well. So there's a few questions for you to have a think about as we go through today's session. As normal, I won't put anyone on the spot and ask them for answers. But if you just get an answer in your head, then we'll go through the answer on the screen and hopefully you'll be able to mark yourself. Okay, so session 5 on single stock options. Let's just remind ourselves what we've done so far. So the first 3 sessions formed part 1. We talked about the basics of options, the mechanics of the product, how we calculate the payoff, why we need to pay a premium. And then we talked about trading options in session 2. How would we take a directional view on the stock using either a single option or a combination of more than one options? So we looked at spreads, we looked at risk reversals. We also looked at how you might trade volatility itself in the market by using straddles and strangles. And actually straddles and strangles are going to come back into play as we move through today's session. And then in session 3, as I said before, we looked at the intuitive drivers of the option price. We ascertained that there are actually 4 main things that change the price of an option. There's the strike, there's the current stock price, there's the time to expiry, and there's the volatility we expect in the market between now and the expiry date. That's where we're going to start today. We're going to start today just proving that all of those things must have an effect on our options price. Last week, in session 4, so the first part of part 2, we had a deeper look at this thing called volatility. And we understood it to be a statistical measure of the width of the distribution of future prices. So a high volatility number means that prices could move a long way from where they start today. And a low volatility number means that the prices are going to be quite constrained in a narrow corridor around where they are today. I finished last session with a question for you. We talked about the fact that when we're pricing options, and we need this volatility number for our price, as we'll see as we get to the formula today, traders don't quote one volatility number for all strikes. They actually quote what we call the vol smile or the vol skew, or actually some people just call it the skew smile. It's a kind of combination of two things. There's a smiliness, so that this would be the smile, where if I've got the at the money options here, then the out of the money options will trade at a higher volatility. And then there's a skew, which is more of a systematic left-right bias, where, for example, here, puts might trade at a higher price than calls. So a low strike put might have a higher volatility than a high strike call. And this is the thing that we call skew. And actually the two of those things combine to make our overall volatility shape that we see on the right hand side there. So the question I asked you to ponder is, why do you think traders do this? Now, there's only really one answer that you could come to here, and that is because they need to change the price. Of those four inputs that can change the price of an option, there's the strike, there's the stock price, there's the time to expiry, and then there's the volatility. If I'm a trader and I want to change the price of an option, the only variable I can actually move is the volatility, because everything else is either fixed. The strike is fixed. As soon as we trade the option, the strike can't change. The stock price is obviously given to me by the price that's prevailing on the stock exchange. And the time to expiry is also a given, because we determined that when we set the expiry date on day one, and the calendar will now tell us how many days there are left to expiry. So if I want to change the price of an option, the only number I can change is the volatility. So the reason we have this vol skew or smile is that traders must think there is a problem with pricing all options using the same volatility. And we're going to reach a point today where we'll draw the conclusion that actually the model that the market tends to use does have problems. And the only way that we can correct for those problems is by changing the volatility number that we put into it in order to change the price that we get out of it. So in many ways, the volatility that we put into an option pricer is a correction for the problems that we know are inherent in that pricing formula to give us what we hope is the correct price. Okay, so that's why you see a vol skew and a smile in markets, and some markets have a more pronounced smile and skew than others. And in equity markets, we often see quite a pronounced skew. And normally it's the low strike puts which have a higher volatility than the high strike calls. And we'll possibly have time to discuss that as we go through today's session. Okay, so what are we going to learn in the next hour or so? Well, we're going to learn how to price options, building up a mathematical framework for how we price them. Now, I should point out that there's going to be no real maths here. We're going to be using high school level maths and nothing beyond that. It's going to be basic probability, but we'll be playing a few games with probability and just trying to figure out how we might apply those to the pricing of stock options. Once we've arrived at a pricing methodology, we'll then discuss where are the flaws? Where are the problems in this? Where are the inaccuracies of my idealized formula when I try to apply it to the real world of stock prices? And then we're going to finish by revisiting this concept of the volatility smile and skew and looking at the kind of products that we would use to express a view on the shape of that volatility smile. Okay, so here are our 4 price drivers: the stock price, the strike, the volatility, and the time to expiry. We're now going to show why all of these have an effect on the price of an option. And we're going to do that by tossing some coins. So I'm just going to share my notepad screen with you now. I want you to imagine that you've got a coin in front of you, and there are 2 sides normally on a coin, and we normally call one the head and one the tail. So imagine that we toss a coin, and it can either land on a head or a tail. And usually, unless there's something wrong with the coin, there's a 50% chance of each. So we have a 50-50 chance of landing on a head or landing on a tail. And if I said to you, if we land on a head, you win 1 real. And if we land on a tail, you get 0. We've now set ourselves up a little probability game for money. Now, if I could play this game for free, then obviously I would, because sometimes I'm going to get nothing, but that's fine because I've paid nothing. And sometimes I'm going to win 1 real. And of course, the fair price for this game is not 0. There is a fair price for this game. And the fair price for this game is a half, 0.5. Because half of the time I'm going to win 1, and the other half I'm going to win 0. If I was to play this game 1,000 times, then I would average winnings of 500 real. So it makes sense that I should pay half a real per game for 1,000 games. The way that we would show this statistically, and some of you may have done this at school in mathematics, is we would work out the expected outcome. And the expected outcome is equal to all of the possible outcomes multiplied by their probability, and then all added together. So we've got 2 possible outcomes. We could win 1, and that's multiplied by a 0.5 probability, or 50%. And then there's another outcome where we win 0, and that's also multiplied by 0.5. And of course, the full answer here is 0.5. Okay, so tossing coins, winning 1 or 0, we can price this game. Let me ask you this now. I have a stock which is currently trading at 100, and tomorrow it can only be trading in 2 possible prices, and that's 101 or 99. And each move has a 50% probability. And I want you to see if you can tell me what is the price of a 100 call option, if those are the only outcomes for the stock. So I'm just going to give you 30 seconds to have a think about this. I would give you a strong hint that it is obviously related to this coin tossing game that we did before, otherwise there would have been no point in talking about it. So we've changed the words here, but the question is, have we really changed any of the numbers? We've got a 50-50 chance of moving up to 101 or down to 99, and I want you to think about what a 100 call option should be worth in this environment. So I'll just give you another 20 seconds or so, and then I'll go through the answer. Okay, so let's think about the answer here. The secret to this, usually people come up with one of two answers to this question. They either tell me that the price is 100, or they tell me that the price is 0.5. And the correct answer is 0.5. If you arrived at a price of 100, you've priced something correctly, but it's not the option. What you've priced is the expected level of the stock tomorrow. What we would say is the mathematical forward price. But we're looking to price the option here. And so the trick to pricing the option is to work out what's the payoff of this option in each of these scenarios. So the payoff of a 100 call, if the stock finishes at 101, is +1, because I would exercise my right to buy at 100, and then I can simultaneously sell in the market at 101 and lock in £1 per share. If the market goes down, my option is now out of the money. I just walk away, let it expire worthless. So the payoff of my option in that scenario is 0. So now you can see, if I compare this to the coin tossing game, even though the words are different, actually all of the numbers are the same. This option has given me the opportunity to either win 1 or 0 with a 50-50 probability, and therefore for exactly the same mathematical reason, the price of the 100 call option is 0.5. Now remember, this is a 1-day 100 call where the stock can move plus or minus £1 per day. And we'll look at different scenarios as we go through the rest of the session. Okay, if I just take us back to the slides for a minute. In the slides we have a slightly neater diagram, not hand-drawn diagram of exactly what we've been going through here. So here is the coin tossing game where you can win 1 or 0, and there's our expectation calculation over there on the right-hand side. And then here is our 100 call, and again, we've got the same expectation calculation on the right-hand side. Now, using this environment, however artificial you might think this looks at the moment, using this environment, I wonder if we can have a think about what the price of some calls with different strikes might be. So we've decided that the 100 call is priced at 0.5. So I wonder if we can price up the 99 call and the 100.5 call. So all I've done there is I've moved the strike down and then up, and we'll see if we can price those two options. So I'll leave this for you to have a think about again for about 30 seconds. This is simply an exercise which requires you to recompute what the payoffs of these new options would be under exactly the same stock scenario that we've just looked at. So I'll say 30 seconds, and then I'll go through the answers to these. Okay, so hopefully you've got some numbers in your head. Let's see if you're correct. Let's think about the 99 call first. And if I just have a look at what the payoff would be as we look at these options. If I've got a 99 strike call and the stock finishes at 101, then my payoff is +2. If I've got a 99 strike call and the stock finishes at 99, then it's right at the strike, but it's not going to produce a positive payoff because I can simultaneously buy and sell at the same price. So the payoff there is going to be 0. So once I've got this payoff, then I know that the price of the 99 call is just the probability of the positive payoff multiplied by the magnitude of the payoff itself. So that's 0.5 probability multiplied by 2. So the fair price of the 99 call is 1. And now let's go and have a look at the 100.5 call. So all that changes here is our payoffs change. If I've got a 100.5 call and stock finishes at 99, it is out of the money in the same way that all of the other options we've looked at have been out of the money when the stock's gone down. When the stock goes up to 101, my payoff here is going to be 0.5 because I'm going to buy the stock at 100.5 and sell it at 101. So now my calculation is going to be the probability of a payoff, which is 0.5, multiplied by the size of the payoff, which itself is 0.5. So the price of my 100.5 call is 0.25. These are all things that we intuitively decided were correct in session 3, that when I move the strike of a call up, its price goes down, and when I move the strike down, its price goes up. But it's nice to see that mathematically we see this coming through. So you can see that when the strike is 100, the price is 0.5. When the strike goes down, the price goes up to 1. When the strike goes up, the price goes down to 1/4. Now I wonder if you can have a think about the supplementary questions down at the bottom of this slide. So I'm just going to clear a bit of space. I'm just going to wonder if we can go back to thinking about the 100 call. But this time, what if the stock started at 100.5, but could still move up or down by $1 per day? So what if this starting point was not 100, but was 100.5, and therefore it could move up to 101.5 or down to 99.5. So what we're modeling here is now fixing the strike and moving the stock underneath it and observing how this price driver must have an effect. So the way I need to approach this is identical to the way I approached the changing strike. I just need to recompute some payoffs. So the payoff of my 100 call in this case, now that it looks like the stock can finish at 101.5, I'm going to get a plus 1.5 payoff if the stock goes up. And I'm still going to get a 0 payoff if the stock goes down, because 99.5 is still lower than my 100 strike. And therefore, the price of my 100 call is now going to be equal to 0.5 multiplied by 1.5, which of course is 3/4. So when the stock equaled 100, the 100 call equaled 0.5. And then when the stock went up to 100.5, the price of the 100 call also went up, and it went up to 0.75. So you can see that, again, in session 3, we deduced that a call option should be more valuable as the stock goes up, because it now looks like it has a higher probability of finishing in the money and producing a positive payoff. And here we see it mathematically. We can also see that effect that we discussed in session 3, which is called delta. My option price has changed by 1/4 for a half unit change in the stock. So for a full unit change in the stock, my option would change by 1/2, and therefore we'd say this is a delta of 0.5 or a 50% delta option, or just for short, a 50 delta option. Okay, so that's looking at a fairly simplistic scenario. I just want to go back to the notepad now and try and think about how we might develop this method of thinking. So let's go and have a look at a stock which now has 5 days to evolve instead of 1. So I can draw this as a 5-step process. It's just the same as tossing 5 coins in a row. This time we've got a stock which is starting at 100 and can now, over 5 days, remember this is still plus or minus 1 real per day. Over 5 days, it could finish at 105, or it could go all the way down to 95. And actually it's got 6 possible finishing points, 2 real in between each one. So they're all the possible possible terminal values of the stock after 5 days have passed. Now, interestingly, if I want to calculate the probability here, what I can do, I can do it in Excel. Excel has a function to tell me what the probability of this is. But what we've built here is what we call a binomial tree. Binomial because it has 2 possible outcomes at every branching point, at every node. It could either go up or down. And if something can go up or down with a 50-50 probability, the probability that it goes up 5 times in a row is equal to 0.5 to the power 5. This is an AND question in your probability, your high school probability knowledge. If I need to go up and up and up and up and up, it's going to be the product of all of those probabilities. So it's 0.5 times 0.5 times 0.5 times 0.5 times 0.5. Now 0.5 to the power 5 can be written another way. It can be written as half 1 over 2 to the power 5, which is 1 over 32. So the probability of going up 5 times is 1 over 32. And the probability of going down 5 times is also 1 over 32. It is actually a property of a binomial tree that the number of outcomes is equal to n plus 1, where n is the number of steps that we're taking. So we've taken 5 steps here, and we've got 6 unique outcomes all the way from 105 down to 95. And the number of paths through this is equal to 2 to the power n, where n is the number of steps. And n here is 5. So there are 32 different ways to finish at one of those 6 final stock prices. And only one of them takes us all the way to the top, and only one of them takes us all the way to the bottom. So that's why we have 1 over 32 as the probabilities there. There are actually 4 different routes that will take you to 103 and 97. Sorry, not 4, 5. Apologies. So the probability of finishing at either of those 2 points is 5 30-seconds, or 5 divided by 32. So I've got 1 30-second probability of finishing either at the top or the bottom, 5 30-seconds of finishing either second from top or second from bottom. I've used 12 paths now to get to those 4 outcomes. There are only 2 outcomes left. There are 20 paths remaining, so they must take me equally to one of those 2 outcomes. So the probability of finishing at 101 is 10 30-seconds, and the probability of finishing at 99 is 10 30-seconds. Now, I'm just going to switch us to Excel because I'm going to put these numbers into a spreadsheet now, and we will have a look at how we might deduce the price of an option. If we have a look at the outcomes, 105 all the way down to 95 in 2 real jumps. I'm going to have a payoff column here for the option that I want to price, and then we've got some probabilities that we've just calculated. So 1 30-second for the top and the bottom. By the way, if you ever want to do this in Excel, there is in Excel a function called binom.dist, and that will give you these probabilities instead of you having to work them out with pen and paper. So what binom.dist says is how many successes have you had? That's up moves in our context. So for this point, we're going to say we've had 4 up moves. It then says how many steps are you taking in total? The answer is 5. It then says, what's the probability of an up move? So I'm going to put 0.5. And it then asks me, do I want the probability of finishing right here or less than or equal to this point? So I'm going to say I want to finish right here. So that's false in this formula. And there is our 5/32 number. If I was to do 5/32 as a number, you'd see they're identical to what Excel's just calculated for me. Okay, good. So I know it's 10/32 for these two outcomes, and then there's another 5/32 here. Always worth with probability, just making sure that all of the options add up to 1. So let me just go down here and add them all together, and there we have it. So there are 6 exhaustive, mutually exclusive outcomes, all with a combined probability of 1. Okay, what I'm going to do now is I'm going to work out the price of a 100 call in this new environment. So let's just color this in a different color. Let's work out the payoff of the 100 call if we can finish at a price of 105, 103, 101, 99, 97, or 95. And the way I'm going to do this, there's obviously a shortcut that you could use. You could just hard code some numbers in here, but I'm going to use Excel's max function and say that the payoff of my option, let me just make this a bit bigger so everyone can see it on their screens. The payoff of my function is whichever is the biggest out of the stock minus the strike. So that's, in this case, 105 minus 100 or 0. So what this max function will do is it will say whenever the stock minus the strike is a positive number, I'm going to return that. And whenever it's a negative number, 0 is now bigger, so I'll return 0. So if I copy this down, we get the payoff of a 100 call under the stock scenario that we've defined. And then I can price this. So remember what I want to do for my expected outcome. My expected outcome is equal to payoff 1 multiplied by probability 1 plus payoff 2 multiplied by probability 2 ... all the way through to payoff 5 multiplied by probability 5. So it's just an extension of what we did when we only had 2 possible outcomes. And there's actually there's an Excel function that will do this for me. So the Excel function is called sum product. So if I use sum product, what it says is it says give me 2 arrays of numbers, 2 vectors. I will multiply each adjacent row, and then I'll sum the results together. So I'm going to say, give me the sum product of the payoffs and the probabilities. And there's my price, 0.9375. So this is the price of the 5-day 100 call. So let's just go back to the notepad for a second. We've got a stock that can move plus or minus 1 real per day. So this is its volatility. So we've defined a volatility for our environment. And what we've changed in our 2 option prices is we've changed the time over which the stock has to move. And we decided that a 1-day call had a price of 0.5 and a 5-day call has a price of 0.9375. So time up, price up. And this is true for both calls and puts. So if I just switch back to the slides now, where I've got a neat version of this all drawn out. Here's our binomial tree. There are 6 possible outcomes, and then off in orange on the right-hand side is the payoffs and all of the probabilities, and you can see an expected outcome being calculated down at the bottom as the price. When we had the previous situation where the stock could go up to 101 or go down to 99 with a 50% probability, then I'm just clearing myself a little bit of space here. If I was to ask the question, what's the probability that the option finishes in the money, as in I exercise my option, then you would say, well, it's 0.5, it's 50%. The exercise probability is 50%. So the probability of exercise in this one-day option is 50%. If we then look at the 5-day option, the probability of exercise is the probability of finishing in one of these three scenarios, either at 101, 103, or 105. So if I wanted to work out what's the probability of finishing in either of those three scenarios, it's the probability of finishing at 101 or finishing at 102, 103 or finishing at 105. So what I need to do is I need to add together all of these probabilities. So what I've got is I've got 10 30 seconds plus 5 30 seconds plus 1 30 second, which of course equals 16 30 seconds, which equals 0.5. So the exercise probability here is still 50%. So the one important thing to note is that when I add time to the expiry of an option, I am not changing, or at least in this fairly simplified environment, I'm not changing the probability that it finishes in the money. But what I am changing is the size of the payouts if it does finish in the money. What we're saying is because the stock now has 5 days to move, if it moves up, it moves further. Of course, if it moves down, it moves further as well, but I don't care about any finishes below 100 because they're all worth 0 to me. All I care about is the magnitude of the positive payoffs I can create, and in a 5-day option, they are greater. So if we have a think about this question on the screen now, why is the price of the 5-day option higher than the 1-day option? I've got 4 options for you here. Let's just walk through them. A, the option has a higher exercise probability. Well, we already know that's wrong. The exercise probability is left unchanged. The size of the possible payoffs has increased. That's correct. The option is more likely to finish in the money. Well, that's just a rewording of answer A, so that's also wrong. It's no more likely to finish in the money. The pricing approach is wrong and it shouldn't be higher at all. Well, fortunately for us, this pricing approach is not wrong. And we'll talk about why it's not wrong in a second. Just before we do that, let's have a think about increasing the volatility. Let's go back to thinking about a 1-day option. So we're going to go back and think about that 1-day 100 call. But this time the stock is more volatile. So what I'm going to say is this time the stock can move plus or minus 1 real every 5th of a day. And our binomial tree now is modeling a full day, but in 5ths of a day. So each increment now is 1/5 of a day, or 20% of a day. And so we can move up or down 1 unit in a 5th of a day. And that means that our possible outcomes now are exactly the same as they were when we could move up or down 1 real every full day, but for 5 days. So all we've done here, we've changed the words, but actually none of the numbers have changed. So if I was to ask you, what's the price of the 1-day 100 call in this new higher volatility environment, then you would say it's 0.9375 again, for exactly the same mathematical reason as the 5-day low volatility call was priced at 0.9375. So the effect of time and volatility, they actually have the same effect. The effect is they just allow the stock to move further, and therefore the option can generate bigger positive payoffs than it otherwise would be able to make. So if you remember our price driver table from session 3, we said that there's these two inputs, two drivers, volatility and time to expiry. And you can see that if they move, if the volatility goes up, then the price of both calls and puts goes up. And if time decreases, then the price of both calls and puts decreases. So we have the same sign of effect for both of these two option types. And down at the bottom, option traders, they view time and volatility as essentially equal, essentially two sides of the same coin. That they are two different factors, but they both have the same mathematical effect on the price. I'll come back to this diagram in a second because I just want to show you this on the notepad. If all we'd done was toss coins and then turned our coin tossing experiments into option pricing, but none of this had anything to do with real life at all, then we would have just wasted 40 minutes of everybody's time. So fortunately, the approach that we've generated to price options here is the approach that the industry uses to price options. And the reason for that can be gleaned if we think about what probability distribution have we just generated for the stock. So if I plot outcome versus probability, then in the 2 outcome scenario where the stock could only move up to 101 or down to 99, we had a relatively boring probability distribution where you've got 2 outcomes and they're both equally probable. Both equally probable at 0.5. And that's what in statistics we would call a uniform distribution. However, when we moved to the 5 time step, things become a little bit more interesting. So if I now plot probability against outcome for our 5-step distribution, so this is either the 5-day call where we could move up or down 1 a day, or it's the 1-day call where we could move up or down 1 every 5th of a day. Remember that we had 2 central probabilities for small movements, and that was 10-30 seconds each. And then we had a medium movement with a 5-30-second probability. And then we had some more extreme movements with a 1-30-second probability. And you don't need to squint too hard at this to see a certain shape coming through. And that shape is what we call the normal distribution. And I think we mentioned this in session 4, but the normal distribution is this statistical property which has an uncanny ability to predict the distribution of many things in life. So if you were to measure the size of people's feet in the office you work in, you would find that the sizes are normally distributed. If we went to Antarctica and measured the height of penguins, we'd find that the height was normally distributed. And fortunately for us, when we look at the prices of stocks, we find that movements in the prices of stocks are normally distributed. So if stock prices are normally distributed, that means we can use this kind of binomial approach to price options. And so fortunately, this has not been a waste of everybody's time. So a binomial tree and a binomial model is a very valid way of pricing an option. What you need to make sure, though, is that the outcomes that it is generating are realistic. And to do that, we calibrate the model to other things we can see in real life. So we want to make sure that our model can price a futures contract correctly. And then we also want to make sure our model can price other visible option prices correctly. And then we could use our model to price whatever option we happen to be looking at. So if I just pop back to the slides. This is the slide that says, as you tend that binomial approach to infinity, to an infinite number of of steps, what you actually get is the normal distribution. And so if stocks are normally distributed, this will work. Okay, I said there was no maths in this session. I was slightly lying. This is the only little bit of maths, but we're not going to do anything with this. We're just merely going to show it on the screen. This is the famous Black-Scholes formula. And this is by far and away the most popular way of pricing vanilla options. So that's basic calls and puts. So all of the spreadsheets you've seen me use over these sessions, inside it was a Black-Scholes pricer. So I've coded this formula into Excel to price options. This formula was designed, well, it really came into public consciousness around 50 years ago now. It was around 1974 when Fisher, Black and Myron Scholes did the work on option pricing, which won them the Nobel Prize for economics. But actually, people had developed this model before Black and Scholes came along and worked with it. What Black and Scholes did is just prove that it was correct. So everyone had arrived at this statistical way of pricing options already. And what the Black-Scholes formula does, if we were to talk about it intuitively or qualitatively, is it tosses an infinite number of coins. It tosses an infinite number of coins and it sees where the stock can go. So let's give it a certain volatility, just as we have with our binomial trees. But let's take the time step down to an infinitesimal jump, and then we'll have an infinite number of time steps. So this is the continuous version of the discrete binomial trees we were having a look at before. Now, this formula is a little bit messy. This is the main formula at the top, and this is the formula for pricing call options. The interesting thing, though, is there's still only 4 moving parts here. What we've got is we've got the forward, or the future, which is F, and we've got the strike, which is K, and we see them appearing again down below. And then we've got sigma, which is volatility, and T, which is time. And there's no other moving parts to this equation. So our 4 main price drivers, for future, or the stock price, represented as the future here, the strike, volatility, and time, our 4 moving parts, they're the 4 moving parts of the Black-Scholes equation. So it just needs a little bit of tweaking into Excel, and you can price any option that you want. Just a word on this bit here, this ND1. What is ND1? ND1 is a cumulative distribution function. So N here is the cumulative distribution function. Again, for those of you who've done a little bit of statistics at school or university, you'll know what this means. This is the probability of finishing less than or equal to a certain point. And so what we're doing is we're taking that cumulative distribution function and we're applying it to these 2 variables, D1 and D2, which are given to us down here. So yeah, a little bit messy. Looks a little bit complicated when you see it on a screen, but actually if we just patiently work our way through it, there's nothing here that we can't do with the help of Excel. And as you can see, Excel has a function called norm.s.dist, which you can use to calculate this N function once you've calculated D1 and D2. Let me just take us back to Excel, because I have, over the series of sessions, I have put in front of you various spreadsheets which have, in session 2, for example, we played around with payoff profiles if we traded call spreads or ratio call spreads or straddles and strangles and the like. And my spreadsheet had a price for the option at all points in time. So what I've got here is I've boiled option pricing down to its simplest form. So I've just got a time to expiry. This is in years, so that's 3 months, quarter of a year. I've got a stock that's trading at 100. I've got a strike of 100. I've got my option type, which is a call, C for call here, and I've got my volatility. So I've got my 4 price drivers here. And then I've got my option price here. So if I just double click on this cell, it looks a bit of a mess, but this is Black-Scholes in one cell of Excel. That's the beauty of Black-Scholes. It is simple, it's easy to code, it prices in the blink of an eye. So it's very, very computationally easy and cheap to process an option price in this way. What we're going to discuss for the remainder of the session is all of the problems with it, everywhere where it's making mistakes. But the world over the last 50 years has not found anything better. When I first became an options trader in the late 90s, so we're going back 25 years, I arrived knowing that Black-Scholes was wrong. I knew what the flaws were in the equation. And I said to one of the senior traders at my bank, I said, are we still using Black-Scholes? And he said, yeah. Why, what else would we use? I said, well, isn't it flawed? Doesn't it have problems? And he said, yeah, well, it does have problems, but we know what they are and we correct for them. And this is essentially where the volatility smile comes from. If we know the magnitude of the problem, we can just move the volatility to give us a correct price, or what the market happens to think at any point in time is a correct price. I said at the time, this is 25 years ago, I said, but aren't there all these better models that mathematicians have come up with? And he said, none of them are better than Black-Scholes, because all of them are much more complex, much more complicated. And actually, they bring their own set of problems with them. They might answer some of the problems of Black-Scholes, but they bring with them a new set of problems. So they're not necessarily any better than sticking with this. So this is why every option trader in the world will still use Black-Scholes as their fundamental go-to option pricing system. Okay, so let's go back to the slides. So here we've got advantages and disadvantages of Black-Scholes. So let's just work through these and just talk about what you might want to just bear in mind if you're using Black-Scholes to have a look at option prices. And by the way, if you're trading options on the Saudi Stock Exchange and it's giving you prices, bids and asks, so you can trade, and then next to it, it's giving you an implied vol number, which is essentially it saying to you, this is the volatility that this option's been priced with, then it will be the Black-Scholes model that it's using to calculate that volatility. Okay, so advantages, it's quick, it can be priced almost instantly. You know, we're talking nanoseconds or microseconds to price. It's simple, so we don't have to come up with an overly elaborate proposition for how the stock can move in the future. We simply say its movements are normally distributed. It's analytic, which means we have a formula. Many more complicated products in finance, you can't boil down to a simple mathematical formula. You have to run simulations to try to price them. You have to use binomial trees to price them. But it's nice to have a clean formula that we can just type into into code and price in a system like Excel or any pricing system that you want to use. And it's also quite reassuring that it's widely used. As I say, every option trader in the world will be using Black-Scholes. They might use something else in conjunction with Black-Scholes so they can just compare the two, but they will always use Black-Scholes as at least one of their pricing methodologies. What are the disadvantages? Well, we talked about a simple environment. That's one of the disadvantages. The assumptions are overly simplistic. And so there's three main problems. One is that it assumes that the volatility of the stock will remain constant. So that plus or minus £1 per day bit, we're saying that that's now not going to change between now and the expiry date. And of course, it can change. Stocks can become more or less volatile. In fact, options will be priced at a different volatility to tomorrow than they were priced at today, which itself is different from yesterday. So we know just by basic market fact that this assumption is not correct. It also assumes that there's no transaction costs. So entering and exiting options doesn't cost me any money, as in there's zero bid-ask spread. And also, if I was to hedge my option, let's say I was going to hedge my delta with a position in the underlying stock, then it's cost-free for me to do that in terms of bid-ask spread. So that's not correct. And the other thing that it assumes is the market trades in a continuous 24-hour-a-day fashion. So essentially, there are no weekends. There are no gaps in the price. Now, you know that a stock might trade during the week, finish here at the end of a week, and then open up here in the first day of the next week, because some news has come out over the weekend and the market has just instantly repriced on the opening of the stock exchange. Now, Black-Scholes doesn't cope with that. It only looks at a continuous path for the stock price. It also assumes that the stocks are normally distributed. Well, actually, this is an interesting word. Last session, I said, if you're trying to calculate historical volatility, what you need to do is you need to look at the change in the log of the price, the natural log of the price, which is very similar to saying you need to look at the change in the percentage movement of the price. So actually, what Black-Scholes assumes is that log changes or percentage changes in the stock are themselves normally distributed. And when we convert that back into prices themselves, that leads to something we call a log normal distribution. And in practice, as we'll see on the next few slides, that's not quite correct. Stocks might move in an approximately normal distribution, but not in an exactly normal distribution. And the final disadvantage, and this might be quite pertinent to those of you listening in, it's only pricing European style options here. So this is not for pricing American style options. There are analytic formulas for American style options. They are approximations, but they're very good approximations. Or if you want to price an American option accurately, you actually need to fall back on a binomial tree or some simulation approach, what we call numerical methods, rather than using a formula. So just bear in mind that your Black-Scholes isn't giving you the American style price. But if you remember back to, I think it was session 1 when we talked about American versus European exercise, the American price will either be equal to the European or it will be higher. And so you know that your Black-Scholes model is at least giving you the minimum value for a particular option if you put in a certain volatility. Okay, so we talk about a normally distributed stock price. What might we see in reality? And there are two deviations from the normal distribution that we tend to see in financial markets. And the one on the left is commonly referred to as a fat-tailed distribution. And the reason for that is you can see down here, the real life distribution is the purple line here, and the normal distribution is the dashed blue line. And it's the tails are the extremities of the distribution, the far left and the far right here. The tails are fatter, as in real life, there is a higher probability that we get a big move. Sometimes people talk about fat tails in finance. Sometimes people talk about black swans. So they're meaning the same thing. What are the chances that we get something unusual happen? And it tends to be a higher probability than the normal distribution thinks. What we also get is a higher probability of nothing happening. So the normal distribution thinks there's a certain probability the stock will remain constant. Actually, in real life, we tend to see a higher probability that the stock remains constant. So we've got this kind of binary possibilities here. We can either get big moves or we can get zero move, both of which can happen with a higher probability than we expected. And of course, this has to be balanced out. The probability of something must be lower. And actually, it's the probability of medium moves, which is lower in real life than the normal distribution thinks. This deformation, this difference to the normal distribution is something we call leptokurtosis. So if anyone ever did that at school or university, this is what we're talking about here. The other effect that we can see is what we call a skewed distribution, where movements one way or the other are not equally probable. Now, the normal distribution would say a movement down 5% or up 5% has the same probability. But in real life, those probabilities can differ. And what we get, this is an example of what we would call negative skew. So the real life distribution is here. And what you can see is it's got a median, a middle of that distribution, which has been pushed up above the 0 line on the x-axis. And then it's got a fat tail on the downside. And these kind of distributions, they're quite common in stocks, where there's a reasonable probability that the stock goes up. Stocks often go up, whether that's with inflation or as new money comes into the market, stocks do grind higher. So you would say that the median movement in a stock over a year is probably going to be slightly up. The probability of a huge move up in stocks is quite low. So actually the normal distribution and real life, they're not too far out in their estimation of the probability of, let's say, a plus 30% move. But a stock market crash happens more frequently than the normal distribution assumes that it should. So this would be a crash. So what we're saying here is the probability of a big movement down in stocks is actually more likely in real life than the Black-Scholes model is assuming. Okay, so it's your turn to have a think again now. So I'm going to leave you to have a think about the question that's on the slide. It's quite a complex question as they've gone throughout these sessions. Let's just talk through it first. What I've drawn for you there in the bottom right is a position that we call a butterfly in options, and that's where I've sold a straddle. Or in this case, that's what I've done. I've sold a straddle, and then I've bought a strangle. And I've not done them in a 1-for-1 ratio. I've actually bought more of the strangle than I've sold of the straddle. And you can see I've done it in a 1.5-to-1 ratio or a 3-to-2 ratio. And what that does is it gives me the payout that we can see on the screen here. And to try to slightly stretch the analogy of the butterfly, we call the straddle the body, and then we call the strangle the wings. So my question to you on the left-hand side is, if a trader puts on the butterfly trade that you can see in that graph, what's their view of the real life future price distribution? What they're doing is they're buying out of the money options and they're selling at the money options. So they must think that the out of the money options are underpriced, so they represent good value, and maybe they're underpriced relative to the at the money options. So if they trade one versus another, they're hedged if everything moves up or down, but what they're essentially betting on is the out of the money options are worth more than the market seems to think they're worth. So I want you to have a think, what future outcomes of the stock would make this person money, and therefore what's their view of the distribution? Is it one of these two things? So that's my question. So I'm going to give you another 30 seconds to have a think about this. Just have a good old mental thrash around with this. It doesn't matter if you're right or wrong. You have a think, come up with an answer in your head, and in 30 seconds I'll go through it. Okay. This is the answer. This is the distribution you're expecting. You're expecting that symmetric, fat-tailed distribution. So let's just think about why that might be the case. And by the way, these butterflies, they are commonly traded by options traders to express a view on their expected future price distribution. So if I trade a butterfly, if I buy the butterfly, I'm essentially saying that the market will be more fat-tailed than the price currently implies. And if I sell the butterfly, I'm actually saying the market will be less fat-tailed than the market is currently implying. So if we have a look at the outcomes which this real-life distribution say will happen more frequently than my option pricing model assumes, then it's either zero moves or big moves. And then if you compare the, if you use that rather and have a look at the payoff profile of this long butterfly position, this trader will make money if we get big moves. And they'll also make money if we get no move. And they are the two outcomes which are more probable in their mind than the Black-Scholes price thinks they are. So they're looking to put this trade on because actually they think, on balance, this will generate a positive payoff for them because they think there's a higher probability of finishing those shaded areas than the market assumes and the model assumes. And notice where they lose money. They lose money on a moderate move, on a medium-sized move, and it's the medium-sized moves which they think are less probable. These moves here in the center of or towards the body of the distribution. So you can see that this long butterfly position is essentially saying, I think this distribution will be fat-tailed, more so than the market currently assumes. So final slide of content for this session. If we're having a look at the volatility smile and skew, so we see a market which is either smiley or very skewed, or maybe some combination of the two, how would we use option combinations to express a view on this market? And so the way that we trade the smile is using butterflies, like the one we've just looked at, or we could use another product that we call a condor, which is actually two strangles, one against the other. But you can see one's a narrow strike range, one's a wide strike range. So what we're really saying again is we're expressing a view on the volatility being used at certain strikes in the market. If we want to express a view on the skew, then we've got a volatility for a put versus a volatility for a call. So it makes sense that we want to trade calls versus puts. And to do that, we trade these things that we call risk reversals in session 2. So if I think that skew will become even more pronounced, as in puts will go up relative to calls, then I want to buy puts and sell calls. And if I think it will become less pronounced, as it'll go more towards flat, then I want to be buying calls and selling puts because I think that's the move in volatility I'm expecting. Okay. Sorry, slight fib. This is the last slide of content. I mentioned that Black-Scholes is not equipped to price American style. So if you are looking to price an American style option, to match it or to calculate something theoretical about the option prices you see trading on the Saudi exchange, then really the difference between the American style option and the European style option all boils down to what is the probability of me exercising before the expiry date? Because if that's 0, then there is no difference between an American style and a European style. If I would never exercise early, then an American style just is a European because I'm going to treat it in exactly the same way as I would treat a European, in which case the prices will be equal. And we talked in the last session about a scenario where it might be tempting to think that we early exercise our American style, but in actual fact, there's something better we can do. We can sell it back to the market, or we could sell the underlying stock itself and realize a higher profit than just exercising now. However, there are certain circumstances where it does make sense to early exercise my American style option. And I've given a slightly exaggerated version of one here. Let's say we've got an American style option, which is going to expire tomorrow. But at the end of today, this stock will go ex-dividend. Now, ex-dividend means there's an imminent dividend payment. And if I own the stock today, I'm entitled to receive that dividend. But if I buy the stock tomorrow, I'm not. And in this case, the dividend is 3 real. So the dividend is 3. So what it means is if I buy the stock today, I get that 3 real. If I buy it tomorrow, I don't. So what should happen when the market opens tomorrow is the price should drop by 3 real to reflect the fact that shares that did give you an entitlement to the dividend now don't. And that's what we see in all stock markets. As shares go ex-dividend, the price drops by the dividend amount. So my question to you, final question for this session, is if you own a 100 call in this environment, the stock's trading at 105 today, it goes ex-dividend tonight, and therefore, if everything else is equal, it will be worth 102 tomorrow. Should you exercise your call today, or should you wait until tomorrow? So have a think about this. Feel free to put some answers on the chat if you want to, either yes or no. And then in 30 seconds time, we'll go through the answer. And there is an obvious answer to this, or rather there is a correct answer to this. Okay. Let's have a look at the answer. Yes. Yes is the answer. Early exercise of an American is only ever the right thing to do if you exercise into what we call a positive carry situation, so that you exercise into something good, which you otherwise wouldn't get if you waited. And in this case, it's the dividend. If I exercise here, then I get 3 real of dividend that I won't get if I exercise tomorrow. So it is worth exercising. And if you want to think about it just mechanically, if I exercise my 100 call when the stock's trading at 105, I could sell it instantly, and then I never receive the dividend, but what I get is a payoff of +5. If I do exactly the same thing tomorrow and nothing else has changed, then my payoff is going to be +2. And so in this situation, it would be optimal to early exercise my American. What you've got to be careful though, and I purposely chose this so there was only 1 day remaining, so there's very little possibility of a big move in the stock. What you've got to be careful is when you early exercise, what you get in terms of that dividend, you lose in terms of future movement possibilities. All of that future volatility, future time to expiry, you are cancelling by exercising now. So it's only optimal to early exercise an American style if the thing that you're exercising into, the good thing, is at least as valuable as the time value you are now losing by exercising early. So it's not a trivial thing to calculate. It's certainly not something you can do in your head. You do need a mathematical model to tell you this. However, if you monitor prices on the exchange, it will be obvious whether or not the exercise is optimal, because you will just be able to see what's the payoff I get if I exercise. If that's equal to the current price of the option on the exchange, then what it's saying is I should exercise. If the price is higher on the exchange, what it's saying is wait. Okay, so we've had quite a journey over these 5 sessions. In session 1, we started talking right back at the basics about what is long, what is short, what's a bid and ask price, what's an option, what's a call, what's a put, how do we understand the mechanics of options. And we've gone all the way through to talking about some of the complexities around pricing, the famous Black-Scholes model, where it's flawed, how I might understand the volatility smile and skew. So I think over what has been, over 7.5 hours or so of sessions, we've covered a reasonable amount of ground. We've got 1 session left. And the idea, as I said at the start, is this session is a bit more freeform than any of the sessions that have gone before. The idea is we've got questions from you, so please turn up with any questions that you want or submit them ahead of time to the email address that's on the next slide. But what I'm going to try and give you, and this will be to a greater or lesser extent, depending on how many questions we get sent. I'm going to try and give you some insights from my trading career when I was an option trader. What kind of things did I see work well, and maybe more importantly, what things did I see work badly? And possibly we can see if we can deduce some experiences that I've had that you should try to avoid having if you want to be successful. We all learn better from our mistakes. We learn even better from other people's mistakes. So I will tell you some of the mistakes I've made, or some of the market environments that I lived through, which were particularly interesting to be an options trader. So that's coming up in session 5. Here is the email address that you email if you've got any questions. So please, if you've got a nice long-winded question that you want us to discuss in session 6, please email through to this address. But also, please feel free to just turn up with questions in your head that you just type into the chat on the day. We can deal with those as well. So I'm going to bring my presentation to a conclusion here. Again, here's the email address if you want to get in touch. Thank you for listening. Thank you for listening for all of the 5 sessions, if you've been with us for all 5. Again, reminder, you can find recordings of them on YouTube, as you can go back and revisit any of these. But I'll pause now. If we've got any questions, we've still got 10 minutes left in our allotted time. But if not, you are free to go. And we will see you next Wednesday at the same time, 6 o'clock Saudi time, for session 6. Thank you.